I'd like to take this opportunity to extend a warm welcome to you all who have joined us on this call for class tonight. As indicated there, we are looking at the concept of mergers and acquisitions, and we're slowly getting into financial analysis. So far, what have we achieved? We have introduced you to the basic methods of valuing a company. That's what we have done so far. Yeah, that's what we have done so far. The question that I used to introduce you to the methods is an odd question. And what that question did was just to basically introduce us to the concepts. What were those concepts? We demonstrated how to do an asset-based valuation using the value of assets on our balance sheet or statement of financial position. We also demonstrated using the common market-based variable, which is the PE. Okay. We also demonstrated using the dividend valuation model. Dividend valuation model. We did that. Then we introduced the concept of free cash flow. That was an order question just to have a feel of all the methods. And I'd say to you earlier on, all the questions used to have in business valuations where we ask you to use different methods to put possible values on the company and then explain the validity or the advantages and disadvantages of the methods used. The current questions, we'll start with the one that you're having tonight. So the question that we're going to do tonight, we want to review again the concept of how do you estimate the free cash flow? That by the time we're ending the last lecture, a few questions, people had questions. How can you manage to pick up all the items that will get you to arrive at the free cash flow? How do you do it, Mr. Perry? Well, tonight we're going to start looking at a series of questions, and after doing 2, 3, 4 questions, you're going to see a pattern. And once we arrive at a pattern, then that fear will completely go. Okay. So with those few remarks, we did distribute the question that you are looking at today. I think all of you have a copy of the question. But in case somebody hasn't got, please let me know so that we can share the question. Yeah. Okay, so let me share the question now that we'll be looking at tonight. This is the question that we're looking at tonight. It's a past exam question, June 2011. And in this particular question, we want to focus mainly on these first 2 parts of the question. The first 2 parts of the question. The other parts of the questions, we're not so much interested. Okay. So the part which is going to drive the point home. The part which is going to drive the point home is that one. That one. That one. And later on, I would want you to get your notes and talk about this part here. Okay, so let me see who hasn't got the notes. I don't have the question. Okay, fine. Let me just confirm, Naomi, that you don't have the question. Let's just check there. Let's just check there. Okay, so she hasn't got the question. True. So let me get to here to ensure that she. Please, if there's anyone else who hasn't got the question, let me know so that I can share the question accordingly. So that I can share the question accordingly. Okay, so Naomi hasn't got the question. Where is she? She's here. My sound is not that clear. Somebody says the sound is not very clear. What of others? Do I have to adjust or be able to get me? It could be maybe the connectivity is clear. So Mr. Katele, maybe it's connectivity. You may have to adjust your connectivity. Good. Naomi, I've sent a question to you. Please, if anyone hasn't got a question, let me know. Eh? Good. So let's start with our question requirement here. Okay. Let's start with the question requirement. Prepare a report to the board of directors of P. That one evaluates whether acquisition of that company would be beneficial to Pursuit company and its shareholders. This is a modern question, which again has been repeated a number of times. This question, for you to answer it, you need to use appropriate valuation methods. How? The question says the free cash flow to firm method should be used. Now, in the last class, I labored a bit to talk about the concept of free cash flow to firm and free cash flow to equity. Free cash flow to firm and free cash flow to equity. I labored a little bit to explain the difference between these, and I said that's what you'll be coming across in your questions. So free cash flow to firm, we're talking about cash flows that belong to both bondholders and shareholders. We're talking about cash flows from which we have not removed the interest payable to bondholders. Okay. So here, we have been told about the method to use. The free cash flow to firm method should be used to estimate the values of Fodder company. They want you to find the value of Fodder company and also the combined company. So there's evaluation needed here. Assuming that the combined company's capital structure stays the same as Pursuit company's current capital structure. Now, some of you may say, these questions are quite heavy. No, this team members has been repeated a number of times by the examiner. After looking at a number of questions, you'll be able to see that, yes, we have seen now that most of the time, free cash flow is the approach to be used, especially free cash flow to firm. And this thing of the capital structure that is going to obtain after the acquisition, this assumption has come several times. So it's up to you just to pay attention as we go through these items. So that's our question for tonight. Okay, we may not finish the whole question tonight because we'll run through it very slowly. We may not finish it, meaning that we'll finish it in the next class, and I'll be telling you about the modalities of next class too. So now let us go into the main question itself. Let's go into the main question now. So here's the question. Let's run through the question together. I know you read through the question, but when we read it again together as a team, we'll be able to point out a few things. We'll refer to this as P. That's what we'll be using, P. P company is a listed company which manufactures electronic components. Is interested in acquiring Fodder or F. So the company to be acquired will be using what? F. In a listed company. So F is not listed, meaning that they don't have a ruling share price per se, because they're not on any stock exchange. Involved in the development of sophisticated, high-risk electronic products. Okay, so they are busy, or they are currently involved in what you call high-risk electronic products, and we're interested in taking over that company. Now, we covered some theory of mergers and acquisitions. There's always a reason why one company wants to take over another. Remember that? We said there are strategic reasons. So when a case is developing like that, start thinking about what we covered in the theory, that what could be the motive? What could be the strategic reason why P wants to take over F? So start thinking about that. The owners of Fodder are a consortium of private equity investors who have been looking for a suitable buyer for their company for some time. P company estimates that the payment of equity value, now this is important, it will come again, equity value plus a premium of 25% would be sufficient to secure the purchase of F. And this is what normally happens when you want to buy somebody's asset. You want to convince them, to persuade them to sell. You need to add something. And normally the premium is in this range of 25%. And that is why we normally say acquisitions are more expensive. One of the things that will kill us in an acquisition is the cost. For us to secure a sale, we need a premium. Now, this 25% really does not represent value per se. It's something, an additional that you pay. So if you're a purchaser, think about that. And when we talked about why many mergers and acquisitions fail, one of the things that we addressed was the issue of the cost. And this cost mainly comes from the premium. The premium is what creates this unnecessary cost, if you want. Because how do you recover that money? How do you recover that money? That is a question. P company wishes to acquire F company using a combination of debt finance, and cash reserves of 20 million. Now, we have discussed this issue, but whenever there's an acquisition, the examiner wants you to think about financing. And one of the things that we can make an acquisition unattractive at the end of the day is the mode of financing and the financial risk that it creates. So when you look at these things, remember the theory that we covered. There's the issue of financing here. A combination of debt and a cash reserve, such that the capital structure of the combined company remains at Pursuit company's current capital structure. Now this, we saw it earlier on again. Pursuit company has a market debt to equity ratio of 50-50. That's the capital structure of P. Has a market debt to equity ratio, meaning that debt to equity is 50-50. So in terms of your capital structure, you must be able to interpret this. This is D over D plus equity. So this is 50 over 50 plus 50 or 50 over 100. So basically that's the capital structure. And this capital structure will be maintained. This capital structure will be maintained. When the company is combined, the combined company is going to have this capital structure. This has been mentioned several times. Let's move. Currently, Pursuit company has a total firm value. They are giving us more information here that we need. On its own, P has got a value. What value? Has a total firm value, meaning that the value of debt plus the value of equity, combining these together, the company is at 140. Fodder company income statement extracts. Now they're giving us information on Fodder. Remember, we need to put value on Fodder. We need to put value on Fodder. And also we need to put a value on the combined company. And the combined company will be Fodder plus P. That's a combined company. So then, this information about Fodder, the income statement, it's got sales, it's got operating profit, after operating costs and tax allowable depreciation, net interest, it's got tax, after tax. The information from here will help us to calculate the free cash flow. And this is standard information. This information will enable us to calculate the free cash flow. And those of you who were in the last class, and those of you who have watched already this recording, I'm sure you have an idea of how to calculate or how to establish the free cash flow. You already have an idea how the free cash flow look like. And that format will always be the same. Where is that format? Where is that information? Fodder company has a market debt to equity ratio of 10 to 90. That's Fodder now, not P. Fodder company has got this. And an estimated equity beta. Now, equity beta has got a meaning. This is a geared beta. This is a geared beta, the equity beta of 1.53. It can be assumed that its tax allowable depreciation is equivalent to the amount of investment needed to maintain the current operational levels. What is the meaning of that? What we see here is an item which is standard on questions on business valuations. What is it? We remember that we discussed that there's two types of routine capital expenditures. In the last class, we've said that one of the items that will enable you to convert a cash flow into a free cash flow is by knocking off routine capital expenditure. And the routine capital expenditure that you have to remove has got two components. The one that is used to maintain our current operations. The one that is used to maintain our current operations. And the other one that is used to grow our operations. So there are two of them. And somebody asked the question, so is it possible that we can have two of them, Mr. Perry, these two types of routine capital expenditures? I say there's no reason why you can't have both of them. We can have both of them. These two, we can have them. The routine capital expenditure needed to maintain operations and to grow operations, we can have both. However, here is a common statement. Its tax allowable depreciation is equivalent to the amount of investment needed to maintain current operational levels. So this figure, this one is the same as your tax allowable depreciation. Now, how do we treat tax allowable depreciation? We are supposed to add it back. We're supposed to add it back. So it means that this figure that you're supposed to add back is the same figure as the one that you're supposed to subtract. It's an in and out. So therefore, this figure will have no effect. We'll talk about it again. So this one will have no effect in this question. What of this one? The question continues. However, if we require an additional investment of 22 cents for every $1 increase in sales, for the next 4 years. This is CapEx, which is required to grow your operations. So this is the one which is active and the one we're going to capture. 22 cents per every dollar increase in sales revenue. Don't panic because we'll show you how to do that for the next 4 years. It is anticipated that F will pay interest at 9%. So some of you are saying, what is that figure for? It will help us calculate the cost of debt. Now, over what period of time are we going to discount the cash flows? Next. For the next 4 years, Fodder sales revenue will grow at the same average rate as the previous years. So for the next years, 1, 2, 3, and 4. For this period, the growth we're going to see is the average growth that we have seen in the past. So we need to find this average growth. After the forecasted 4-year period, the growth rate of its free cash flow will be half the initial forecast sales revenue growth for the foreseeable future. With this now, we are going to arrange cash flows to enable us, first of all, identify the free cash flow. That is step number 1. Free cash flow. That's our step number 1. So let's go. How do we get the free cash flow from here? So those of you are using spreadsheets, please put your spreadsheets on. Those who are just taking down the notes, also be ready for the table that is about to follow. So I've cut and pasted this myself in my Excel. Okay. We want, first of all, to estimate the market value of Fodder. If you ask me, Ms. P, what do we want to do? We want to evaluate the free cash flow firm should be used to estimate the market value of Fodder and combined company. So we want to estimate the market value of Fodder using the free cash flow to firm method. That's what we want to do. Free cash flow to firm. Okay. So step 1, how do you calculate the free cash flows? How do you calculate the free cash flows? This is your format for a free cash flow. Revenues, which are supposed to be growing. That's step number 1. So you take your calculators. You take your calculators. (2011, 2010, 2009, 2008). So you take your records for 2011. The sales figure. What's the sales figure? 16,146. We're going to grow it. How are we going to grow this figure? Using the historical growth rate. So your first task is to tell me this figure has grown from there to there. What is the average annual growth rate? The growth is number 1, number 2, number 3. What has been the average annual growth rate is the one that we are going to use for the future. That is our task number 1. And this task, you're going to do it not only once, but a number of times on this paper to find the average annual growth rate and assume that in the future we expect the same. Assume that in the future we expect the same. Please take your calculators. In case you have forgotten how to do the calculation, our calculation is here. Here we are. The growth has taken place from there all the way to here. So the annual growth rate is 16,146. So you take the most recent 16,146. You divide it by the original figure 13,559. You divide to the power 1/3 minus 1. Then you multiply by 200. That is how we calculate the average annual growth rate. That over that divided by to the power 1/3 to find the average annual growth rate. If the growth had been 4 times 1/4, 5 times 1/5. I'm sure if you do that correctly, you are finding that the growth is 6% per year. Can somebody confirm that?
Yes, the growth is 6%.
Okay. Please, confirmation is very important. I'm told it's been confirmed. So we're going to grow our sales by 6% every year. Second, our operating profit margin. Let's check our operating profit margin every year. And that's the same figure that we're going to use, the average figure we're going to use. Where are we? Okay, let's go. Your operating profit figures every year are here. The operating profit figures every year, they are here. Out of the sales of so much, these are operating profit figures. So these are operating profit figures on these sales. Now, you may remember that in the last question that we did, the operating profit margin was given, and in some questions it's given, but here we have to determine it ourselves. So how do you get it? 5169 over 16,146. That was the margin for 2011. You repeat the same, 5074 over 15,229. I'm going to repeat this process every year. Another way is you can just add up all these figures, come up with a total there. Add up these, come up with a total there, and just do this profit over that. Or you can work on individual years and just divide by 4. So these are the possibilities that we have. Okay? So with that in mind now, let us see what answers we get. Mine gives me an average of 32%. I get an average of 32%. When I check these figures, that one, that one, that one, and that one, I get an average of 32%. Another possibility, if you don't want, like we have said, another possibility, if you don't want, like I've said, You can also take a different approach. Like I've said, if you don't want, you can take another approach. What is the approach that you can take? You can add up these figures. You can just add up these figures. Let's go. Let's add up the figures together. And then you simply say, let's go, that divided by that. I'm getting 32 again. So if I use the totals here, I still get the same answer of 32%. If you do the individual one, get the same. Okay. Growth rate, 6%. Profit margin, 32%. With that now, let's come to our table here. And I hope some of you are typing and typing quickly. Here we are. There we are, people. So some of you are saying, wait a minute, Mr. P, where did you get the first one? Some of you are saying, wait a minute, Mr. P, where did you get the first one? No pressure, no pressure. 16,146 multiply 1.06. That's what I've put in here. 16,146. 16,146. 16,146 multiplied by 1.06. There we are. Next year, 6%, 6%, 6%. Are we all happy with the revenues? You are going to, the questions on mergers and acquisitions, you find that a number of them have been repeated. So what you are doing here in this worksheet you are setting up, most likely it's the one you'd use also in an exam situation. Let's come to operating profit. Operating profit, we have said, is 32% of each one of these figures. So you apply 32% on each one of these figures, and that's what you get. Lesson. The figure that we need to convert into a free cash flow is operating profit. Lesson. The figure that you need, to convert into a free cash flow is operating profit. And you may remember that the other term for operating profit in your income statement is profit before interest and tax. That's the other term. Profit before interest.
Mr. Piri, I think I'm a bit behind on how you are getting the 32% and why you are using revenues to get the operating profit.
Okay, let's go. So we are told that what has happened in the past, that's what you expect to happen in the future, the next 4 years and beyond 4 years. So first of all, we calculated what is the average annual growth of sales. What is the average annual growth of sales? So we have calculated that these sales have grown from 13,559 to 146, and we found the average annual growth rate of 6%. But what was the relationship between operating profit and sales? We have said that in 2011, it's 5169 over 6146. 2010, 5074 over 15229. So you can get the operating profit margin by using the historical relationship between operating profit to sales. So that over that, that over that, that over that, that over that. Or if you don't want, you can just add up all these figures they gave you total sales. All these figures, they give you total profit. And just say the total profit, total operating profit, total operating profit over total sales. That's what we can use. And that's exactly what we have done in our worksheet. That's exactly what we have done in our worksheet. Here, the person who asks the question, this is what we are doing here. That over that, 32%. That over that, 33%. That over that, 29%. That over that, 33%. When you take all these figures, you add up all these figures and you work out an average. All these figures, when you add them up, the average of these figures is the 2%. If you went by total, you take your total sales and the total operating profit, you again get the 2%. Have you seen where the figures come from? The person who asked.
Yes, I have.
You have now.
But are we doing that because the question has said that there's a relationship between the sales and the operating profit, or is it just an assumption?
Operating profit margins, as you know, are always, as you can see even from this pattern, are always a constant proportion of your sales. I'm sure even from your analytical reviews, you know that there's a relationship in operating profit margin. In some questions, they tell you, but there's always a relationship in operating profit of the company and the sales.
Okay, thank you, sir. Now it's understood.
Okay. All right, thank you for the question there. It's better to slow down like this, because as we slow down also, it gives people an opportunity to think through what we are doing and also to assess our figures, isn't it? I'm sure some people will also use the opportunity to punch in the figures. Now, what lesson do I want you to pick from here? My lesson is very straightforward. I want you to realize that to calculate the free cash flow, your starting point is operating profit. That's a simple point I want you to carry home. I hope that is okay. If somebody says in the exam, how do we calculate the free cash flow? The answer is use operating profit figure. From there, we remove the tax. What's the tax rate? 28%. There we are. This format is the one we are going to use: revenue, operating profit, and tax. Then after there, most of our questions, we need to knock off the routine capital expenditure. Let me call this routine. Let me add routine. Now, some of you may say, wait a minute, can you talk about what we saw in the question about the tax allowed depreciation and all that? Talk about it, Mr. Piri. That is very good. Now, if you notice in my worksheet, I've brought all that information here. Okay, so let's talk about it now so that we clear it once and for all. How do you convert a profit figure to a cash flow? How do you convert a profit figure to a cash flow? Ideally, we need to come here and add what? Add back what? Depreciation. Yes, you're right, depreciation. And when we come here, we are supposed to remove two items. What are those two items? Let's go. After we add back, by adding back, we are converting profit into a cash flow. To convert it to a free cash flow, we are supposed to take out what? routine capex. We are supposed to take out routine capex. How many types of routine capex do we have? How many types do we have?
Two.
Routine capex. One is to do what? The other one is to do what?
To grow.
To grow operations. Now, what the question is telling us, and you're going to see this again and again, is this statement here. It can be assumed that its tax allowable depreciation, the one you're supposed to add back, is equivalent to the amount of investment needed to do what? To maintain your current operations. So what does that mean? In accounting, this is what we call what? In and out. This figure that you are supposed to add back is the same as this figure that you are supposed to do what? To subtract. This will come again and again on this paper, and we'll be making a reference to it. Is that okay? So then, the meaning is when you come to a table here, what they're saying is that this line here, the figures here, and the figures here are equal, are same. That is why they have not even given them, because these two figures are same. We can assume that this figure that you are supposed to add back here is the same as this figure here. And they have not given it because you don't need it. It's an in and out. It is an in and out. If this figure was 100, it means that it was supposed to be 100 everywhere. Even here, it's supposed to be 100, this figure. That's the meaning. So there's no need of making this adjustment then. So this, in this question, is not necessary. Take it out. Have we followed the story? That's the meaning of that. So the only capital expenditure that we need then, is the one to do what? To grow our operations. It's the one for growing our operations. That's the only one we need. Is that okay, people? That is the only one we need. And what is it? Let's pick it up. 22 cents per $1 increase. Now, what was the $1 increase in the first year of operations? Currently, what is our current sales? What's our current sales? 16,146.
Okay.
So there's a growth from 16,146 today, and 1 year times what? 17,115. So let us now calculate then. Let us calculate. There we are. 16,146. 16,146. You subtract from 17,115. There we are. What of the following year? 18,142 minus 17,115. That's the increase in sales. You multiply that by what? 22 cents per dollar. Are we all getting that? 18,142 less 17,115 multiplied by 0.22. That gives you 226. 19,230 less 8,142 multiplied by 22 cents or 0.22 gives you that. That is the capex that was needed here. The other one, it wasn't needed because it was an in and out figure. Lesson, how to find the free cash flow. And this is the free cash flow to firm. Why? We haven't removed the interest from these figures. That's where we are. Are there any questions on how to find the free cash flow figure? If anyone has remained behind, it's better we slow down and we talk about it. Okay. The
Yes,
next.
Mr. Piri,
Yes, please.
I have a question. I'm kind of behind on the operating profit. I'd lost the connectivity.
Okay. What of yours? You're okay with revenues?
Pardon?
Are you okay with the revenues? The revenues are okay?
Yes, sir.
All right. So operating profit.
Yes, they're okay.
Historically, it was 32% of sales. Our operating profit historically was 32% of sales. That's what worked out here. And therefore, we have maintained the same ratio. So when we check the average of these historical figures, it gives us 32. So the operating profit is 32%. Please, 32% of that figure. Is that okay?
Yes, it's okay.
Now the discount rate. We will never graduate from cost of capital. These figures here are called free cash flow to firm. Why to firm? We have not removed any interest. We have not removed any interest. So what we see here are cash flows that belong to both groups. What groups are these? The bondholders and the shareholders. We now want to discount these cash flows. What discount rate are we going to use? We're going to use a discount rate which reflects the owners or the providers of these funds. So the discount rate you need here is a weighted average cost of capital. Weighted average cost of capital. So the question says, please, can you calculate the weighted average cost of capital? Now, for you to calculate weighted average cost of capital, you need the cost of equity and cost of debt. Cost of, and also the capital structure. You need the three things. You need the cost of equity. We need the cost of equity. We need the cost of debt. And we need the capital structure. So we need the capital structure, the proportion of debt, and the proportion of equity within your capital structure. And that's what they have nicely given us here. The capital structure has been given here. What of the cost of debt? The pre-tax cost of debt has been given here. The only issue now is the cost of equity. So you ask yourself, how am I going to calculate my cost of equity? The answer, they have given us an idea here. That we may have to use a but. Where is the other clue about the approach to be used? The other clue was in the information given, where here they're giving you the government base rate of, they're giving you what else? Market risk premium. So with this, it confirms that the approach we are going to use is the capital asset pricing model. Is that okay?
Adding the interest, the cost of debt, how do we know that it's pre-tax?
Yeah. It is anticipated that Fodder company will pay interest at 9%. The interest rate which the bank quotes for you is pre-tax. The bank doesn't know your tax position. It's up to you who knows your tax position. The relevant tax applicable to you is 28%. So it's your responsibility to convert this figure into a post-tax. You have asked a good question, actually.
So we have to find essentially 72% of the 9%.
Yeah, exactly.
Okay, thank you.
Good. So then, with all that in mind, there we are, using the capital asset pricing model, cost of equity, the cost of debt, and using the proportions given here. Using the proportions given here, we are now able to finalize your deal. And that's your 13% there. Cost of equity. Now, some of you say, Mr. Perry, please remind us a little bit on how we calculate the cost of equity using. So cost of equity equals, let's go, risk-free plus the beta minus that's your formula there, in case you have forgotten, but I know most of us to remember. So what was given here, they gave us a premium, meaning that they subtracted already. In our question, they gave us, here we are, your risk-free is here. The market risk premium is 6. What does the expression market risk premium mean? This is a market risk premium. They've already done the subtraction. That is why we just pick this 6 the way it is. And the beta of this company, the equity beta of this company, as we saw there, it was 1.53. Are we all happy? Are we all happy with the cost of equity? So this is our cost of equity. The risk-free is given here. The beta is given here. The premium is given there. So just multiply and add that. The post-tax cost of debt, you take 9%, and then you knock off 1 minus T. So 13% is the weighted average cost of capital. Please, if there are questions, let's ask. Don't feel shy. I'll slow down. I'll slow down and explain. So don't think like what do others think about me. No, it doesn't work that way. That logic doesn't work very well. You just ask. If you have forgotten something, it's our responsibility to remind you. What of beyond?
Mr. Piri, just
Yes, please.
question.
Yeah.
On the beta that we use to calculate the cost of equity,
Yes.
it's the equity beta?
It's the equity beta.
Okay.
Here, this one here.
Okay. Thank you.
I'll share this worksheet too. I'll share this worksheet because I've already cut and done it to cut and pasting. It will help you a lot. Okay. So year 1 to 4 is not an issue. Remember, just normal discounting. The problem is what happens beyond. So what happens beyond? We borrow a principal. We borrow a principal. What principle do we borrow? What principle do we borrow on what happens beyond? So what happens beyond? There's a principle. So the principle is that we are going to use comes from the dividend valuation model. In a dividend valuation model, we say the share price is given as dividend after 1 year, cost of equity minus. That's how we find the share price. If you've got a dividend which is growing at a constant rate every year forever, this is how we get the share price. The dividend after 1 year, the dividend after 1 year, you grow the dividend by 1 year. Then you divide by the cost of equity minus the G. G is the growth rate in the future growth rate in the dividends. So if we have got a dividend which we expect to grow at a constant rate every year, forever, its value can be estimated using this. We borrow it and use it now on free cash flows. If you've got a company which has got free cash flows, which are expected to grow every year forever, the total value of that company, we take the free cash flow, grow it by 1 year, divided by weighted average cost of capital minus the G. We repeat that. In a similar way, if we have got a company expecting a free cash flow that is going to grow at a constant rate every year forever, the present value of those cash flows can be estimated by adapting that approach. Where there's D1, what do we put in now? We put free cash flow after 1 year. Where there's cost of equity, what do we put? Weighted average cost of capital. And this is the expected future growth rate in the free cash flow. So which figure are you going to pick? You're going to pick this figure and you grow it. What have we been told about the growth rate? the growth rate will become half of what it was in the first 4 years. The future growth rate will be half of what we saw here. This was growing at 6%. Beyond, the growth will be at 3%. How is that? So then, what will happen is that we are going to take your 4, 4, 4, 3. You multiply this by 1 plus the future growth rate, 3%. You divide this by 13% minus 3%. How would that look now? Okay, so now we come here. We do that. We come here. Here we are. 443 multiply 1.03 over 13% minus 3%. You find this answer here. That's your answer you find. Please, can somebody verify this figure for me? Can I get somebody to verify that figure?
Yes, it's correct.
Okay, so somebody has verified that figure, that Mr. Perry, the figure is all right. Now, this figure, we spoke about it. I'll speak about it again. This value that you calculate, this one, it's a PV as at end of year 4. So this figure is a present value, but it's at the end of year 4. To bring it to what it is today, you need to use the year 4 discount factor, put it there so that this can be converted into a present value. So now we've got the value for beyond. So the present value for everything that will happen after the first 4 years is this figure here. And then you add it together with what is happening in the first 4 years. And that gives you 40,094. This is the market value of F using the free cash flow method. So all the future cash flows to be generated by this company, when you discount them, we're getting a value of 40,094. And today, that's where I want to end our story. Today, that's where I want to end our story.
Mr. Piri,
Yes,
in
please.
exam 13, would we get penalized if we rounded these figures?
No.
From the
No. Your marking team, in fact, let me talk about the marking process. Let me talk a little bit about the marking process. You have done very well to provoke the discussion on the marking process. How you pass this paper, or people pass this paper, it's not that they got all these figures, no. It's a process. What is marked by and large is a process.
Okay.
When I get a worksheet, before I even start marking, I'll tell that this person knows the topic or they don't. An average student who has prepared well for this paper, what I'm going to find is a proper table arranged like that. So once we see that, note, this student has prepared for a question on how to value a company using the free cash flow method. Secondly, imagine that somebody used a wrong percentage here. Instead of 6%, they use, let's say, 4%. So these figures will be wrong, so you lose a mark. So if there was a 1 mark split for all this, or 2 marks, you lose the 2. You come here, the operating profit, 32%, you go to 32% and use it correctly, marks are going to be given. Tax rate, you use the wrong tax rate, you're going to lose marks on this. CapEx, you do a good job. You know, the way HCA marks, when it comes to this, you're going to be given your marks. Why? There's what we call the own figure rule. The wrong figure which you have calculated yourself, the wrong figure that you have calculated yourself is called an own figure rule. Own figure rule. The wrong figure that you have calculated, once it's being used subsequently, you don't lose marks again. You don't. Another example, you get it wrong, you get the weighted average cost of capital wrong here. You get 10%. You lose marks. So if we are giving 3 marks for the discount rate, if this figure had 3 marks, you lose the 3 marks. You won't get the 3 marks. Now you come here. You got 10%. You use 10%. These figures are okay. You use 10%. The resulting figures will be given a mark. We won't say, no. These are also wrong because that is wrong. It doesn't work that way. That is how people pass this paper. And almost all the papers. Otherwise, if we are just saying, let's just focus on this last figure, none of us would pass. But you find there was even a prize winner here, a person who got 85%. How did he get 85%? He was only penalized once. So remember, what is critical in this paper is to tackle all the questions. You must attempt all the questions, and you must present your work well. Even when you know that, these figures don't make sense. They are too small. I've made a mistake. Forget about that. Mistakes are not carried forward. That's why SC marks papers.
Thank you, sir.
Are there any questions on the first evaluation I've done today? Yes, Mr. Mufwera.
I had connectivity problem. On the first part, on the revenue, how you got the 6, is it the 6% increment? From year to year. I think I had connectivity problem when we started.
Okay. So the 6% came from here, Mr. Mfwewa. This figure grew from that one to this one. So the growth rate, the annual growth rate is 16,146 over 13,559 the power 1 over 3. Why the 3? The growth has taken place. That is 1. That is 2. And that is 3. So that's the 3 here. which we have. So this is the 3 that we have here. Then you subtract 1 and multiply by 100.
Okay, it's clear now.
Excellent.
Thank you.
Please, between now and the next class, build your own worksheets. Do the question again. Practice and see what happens. Now, in view of the time that we are having and people who are heading for the March exams, there was a class which I was supposed to be taking for youngsters on a Saturday. And I was supposed to be taking this class starting from 14:30 to 16 hours. So I found myself with a slot which I wanted to dedicate to this group, especially considering that we've got a number of students that are sitting exams next month. So 4 sessions will help us to move at a good pace so that we do a lot of discussions. So I am proposing that we put a 4th session here to enable us to get ready for this exam. So that is a story that I have to sell to all of you, that for the next remaining 5-6 weeks, we need at least 4 sessions in a week. And the other session where I have a free slot is that there. What's the reaction of the group?
It's a most welcome idea, Mr. Pire.
Thank you, sir. I can manage.
That's fine.
Yes, this is in your interest. I mean, I would have chosen to be watching soccer during that slot, but I've given it to you so that we get ready for the exam. Okay, fine. So let's do that, people. So just after tomorrow, then we have a class. In our class, we'll be continuing. We'll be continuing with the same story. We now want to look at evaluation for the combined company. Again, want to go through it slowly and discuss a number of items. And then by the time we come to our Sunday, the usual class that we do on Sunday 16 hours, then we'll be able to talk about what you have learned and also start another question. So just after this one, we'll start another one, and then we'll start another one. Then we'll close the business valuations and go to the financial risk management. Good people, thank you very much. Good night. We see you Saturday, 14:30. I'll post on the forums. That is the class on Saturday at 14:30.
Thank you, sir.
Thank you. Thank you so much.
Thank you. Good evening. Thank you.
Thank you.
Good evening.